Techniques Lecture number 541. Every time a position is taken, there comes with it a potential for profit or loss. Every time a position is closed out, a profit or loss is realized. For many students, this is all they look at. What they are failing to take note of, however, is the learning experience that should go along with each trade. Unless every action we take in the market can somehow be used to add to our cumulative knowledge and understanding, there is almost no chance for improvement, which is something that very few of us can do without. The secret to successful self-analysis when it comes to the stock market is total objectivity and complete control over fear and greed. Unfortunately, this degree of self-control is probably beyond most of us. Therefore, we tend to learn the hard way through our mistakes, assuming we are willing to admit them. In an effort to reduce the number of these errors, we are going to devote this discussion to an analysis of the actions taken by others. Some of the trades that will be considered are very good. Others, however, are questionable at best, and some may be just plain wrong. In spite of their outcome, though, each has lessons to teach. The object is to learn the lessons here so we can profit from them later. In the trades that we are about to analyze, it should be remembered that each was made by a different individual. Some are longer-term oriented, but most seem to favor the shorter term. We will attempt to reconstruct the reasoning behind each as best we can from the information supplied. Where important details are lacking, we will attempt to hypothesize about what might have been in the trader's mind at the time the action was taken. Exhibit 1 is a chart of storage technology posted through Thursday, October 23rd. From the information supplied, the action on the day that has been marked with the X is seen as being critically important and justification for taking a position. Therefore, please cover up the action that occurred after this point. It was not available to the trader at the time he took his position, so it is not fair for us to base our analysis on information that was not known at the time. The action at point 1 in May is seen as being especially important. This is a justified conclusion. There are 3 factors that point to that action as representing the end of the move. The first is a previously established count at the 20 level, with its objective of 31 to 33. At point 1, this objective has been met. Also at point 1, we can see that there was an unusual increase in volume, which is often associated with the end of a move. The third factor is the overbought condition of the major uptrend, established on the move up to 35. These 3 put together form a very formidable resistance point. They point out the need for some type of corrective action and hold out the possibility that a buying climax has occurred. Consequently, we construct a resistance level at 35 and 5/8. The stock next moves sharply down to between 31 and 32, where it meets support. This is the end of the automatic reaction and allows us to construct the support level of a new trading range. To prove the possibility of a buying climax at point 1, and to confirm the new trading range, the next step should be a testing of the top. This occurred at both point 2 and point 3 on lower volume. They were convincing tests. Normally, we would expect to see these tests more nearly approximate the level of the climax. The fact that supply came in so much lower can be taken as an indication of weakness. After point 3, there is a sharp decline on the order of a fall through the ice, followed by a rally back to that ice level at 32. This is the last point of supply, which allows a down count to be taken. The result is a downside objective of 24 to 27. The price met support in the upper portion of this objective. We have now traced developments to about the middle of July. What have we seen thus far? First, we saw a stock that overran its upside objective on the move to point 1. This is an indication of strength. We then saw a rather substantial reaction, which the figure chart reveals to be nothing more than a normal halfway correction of the previous advance from the 18 level. This is an indication of continuing long-term strength. Finally, we see the stock met support in the upper half of its downside objective range, which is also an indication of some strength. It is true that on the move from 1 to 4, storage technology was weaker than the general market, but the other positive indications at least balance this one negative indication. The stock now begins to resume its long-term uptrend action. At point 5, an objective for this next phase is set in place. It points to the area between 38 and 40. The next move of significance is the rally to point 6. Here, the stock penetrates the overbought line of the intermediate uptrend and respects the resistance level established back at point 1. It should be noted that it is just about a week before our trader felt that action was warranted. The overbought position at 6 indicates some type of correction. This is accomplished by an immediate retreat back into the trend channel. We now rally up to day X, the point at which our trader felt action was warranted. His decision to go short by way of buying April 30 and April 35 puts, was his action correct? At best we could say he was premature. At worst we would have to say wrong. On day X, the stock was not overbought. It had not reached its upside objective, and none of the 3 uptrends had been broken. It had also just come off a period of substantial relative strength when compared to the market, which had recently weathered the final stages of a sharp decline. With all of these factors working against his position, why did he choose this stock to sell short? The reason for selling short is clear and justified. We can see it by looking at the picture as of October 6th in Exhibit 2. There is good reason to believe at this point that the automatic rally is nearing an end. This comes from the overbought condition of the market indicated by the technometer. The move that normally follows an automatic rally is the secondary test. It appears as though our trader was trying to take a short-term, short-side profit during this test. His critical mistake was in trying to do it in a relatively strong stock. If you have a chart of IBM for this period, get it out and compare its position to that of storage technology at this point. Who is weaker? Your answer should be IBM. Which represented the best candidate for a profit on the secondary test? Your answer should again be IBM. Which stock made a 5-point decline on the secondary test? The answer is again IBM. Now, let's go back to Exhibit 1 for a few moments. This trader's decision to short storage technology appears to center around the respect shown to the resistance on the rally to point 6. Apparently, he was looking at the rally to X as a successful test of that respect. This is something along the lines of an upthrust and test, but there is one crucial difference. There had been no upthrust on the resistance level. Therefore, any perceived test at X had no significant meaning. The decision to buy April puts suggests one of two things. The first is an aim to be conservative. If this was the thinking, it is certainly sound. On the other hand, it may indicate an anticipation of a major decline. If so, it represents a major error in judgment. Remember, the general market at this point was trying to stop a major move. It is not impossible to have an individual stock so totally out of phase with the market that it would be beginning a major decline at this point, but there is reason to doubt the wisdom behind a decision to attempt trading it. There is also a problem with the down count. If this trader was looking for a major decline, he probably was counting the 35 line for a downside potential of 24 points. To justify this, the action at 6 and X would have to have been an upthrust and successful test. We have already seen that this was not the case. Therefore, that count could not be justified. Another possibility is that he was counting the 34 level. This would have resulted in a 9-point potential. If we assume that he took this position at the high on day X of 34 1/8 and had determined that he was going to maintain a 3-to-1 profit-risk ratio, he should have sold his position when the stock hit 37 1/8. Here is an alternate way he could have handled his mistake. On October 6th, the day picked for action, the April 35 puts closed at 4 1/2. He was anticipating a move in the stock of 9 points down to 25. If that happened, his options would have been worth at least 10. Therefore, he stood to make a 5 1/2 point profit. If he was willing to risk a third of that profit, his mental stop should have been placed 1 3/4 points below his assumed price of 4 1/2, or at 2 5/8. The day the option traded at that price, he should get out. Either of these approaches to getting out is acceptable. Generally, it is suggested that the trader go with the one that results in the least damage. As we have seen, there were several errors made in this trading experience. Any one of them could have resulted in a loss. However, not making the most critical one could have spared the loss. The lesson to be learned here is to never, ever short into a relatively strong stock or buy one that is relatively weak. The next set of trades was initiated back in August, on August 11 to be exact. They were made in options, which happened to be nearby contracts. This is a term used by the trader. It suggests that he chose the contracts nearest to expiration. Therefore, it seems reasonable to assume that these trades were intended to be short-term in nature. Additional information supplied by the trader indicates that the options he selected were out of the money at the time of the trade. As a rule, the trading of out-of-the-money contracts should be looked upon as being a mistake. Generally, it is done with the idea of providing an extra added measure of protection. The reasoning is that since they are out of the money and their price is totally premium, the downside risk is reduced. This is true, but this positive factor has an equalizing negative factor. The premium, which helps to reduce downside risk, also helps to limit upside potential. As an out-of-the-money option approaches and then moves into the money, it must give up some or all of its premium. This occurs at the expense of the potential that is being consumed as the option is being lifted into the money. The only way to offset this is to only trade options of stocks that have massive buildups of potential, which implies a longer-term move. Therefore, if a position is taken out of the money in an option relatively near to expiration, the odds are that the stock will not move fast enough to compensate for the erosion of the premium. A longer-term out-of-the-money option in a stock with massive potential can be justified, but even here the contract should not be too far out of the money. In choosing out-of-the-money options in what appear to have been intended as short-term trades, our trader is likely to be involving himself in the worst possible situation. The short-term nature of his trades implies that the potential in his stocks is not massive. The relatively short period of time to expiration of the contracts means that the premium that has been bought would erode rather quickly. Therefore, by buying out of the money in this case, the trader faces the frustrating possibility of being right in his analysis of the stock and still not making a profit. To avoid such situations, a good rule to follow would be that if your level of confidence is not high enough to buy in the money, or no more than 1 point out of the money, there would be a significant level of doubt, and the best thing to do would be to do nothing. As mentioned, these 3 positions were established on August 11. From the information supplied by the trader, it is clear that his decision to act was based first on consideration of the general market. Now, this is as it should be. If the position of the general market does not support the taking of positions, it is unlikely that most individual positions would yield a meaningful result. Exhibit 3 is a chart of market action posted through August 11, the day on which the trades were made. That means it must have been the action through the day before, that being August 10, that led to the decision to buy. What did our trader see? There were probably 3 factors primarily responsible for the decision to take positions on the long side of the market. One almost certainly had to be the relatively oversold condition of the technometer. Buying when the market is in an oversold condition tends to reduce downside risk. Therefore, our trader would have been justified in concluding that the odds were in his favor at this point. Another important factor in the decision to trade probably was the obvious divergence between the Wyckoff wave and the OP index. The substantial net downside effort in the days leading up to August 10, plus the resistance shown by the wave to that effort, indicated the likelihood of a turn upward in the wave once the downside effort began to ease. The third of the important factors likely was the low volume on August 10. The wave was attempting to make progress on the downside. The relatively low volume indicates a lack of interest in that effort. Therefore, this can be seen as a positive development. The 3 factors just mentioned are together very convincing. Most of the time, they would form the basis for a good rally, providing there was potential to back it up. In this case, a count extending from point 1 to point 2 would have seemed in order. In addition, there appears to be the possibility of an extension of that count over to point 3. Therefore, our trader had reason to expect a relatively good advance. It might sound as though this was a perfect situation for buying, but that would be going a little too far. Perfect situations are relatively rare, and most of us do not have the patience to wait for them. We usually know what is right about a particular situation, but often we overlook what is not right. This is probably a response to that usually overwhelming urge to be doing something. In this case, the downward moves in the force and momentum are what kept the situation from being perfect. If they had been moving up, everything would have been saying, buy. We know now that the best the market could manage from its August 10 low was an extremely feeble rally. In all likelihood, we would not have seen the failure of the market to perform until it was too late. Therefore, stock selection would have been extremely important. It may not have avoided a loss, but it could have helped prevent a disaster. The 3 stocks selected in this case were Hewlett-Packard, Hughes Tool, and IBM. Each has been marked with a day X, which is August 11, the day on which the positions were taken. Hewlett-Packard had one good move earlier in the year in the advance from 40 to 53. This had been followed in June and July with a correction back to the 44 level. This represented more than a 50% retracement, which put the stock substantially in harmony with the market over the immediate term, but still maintained its position of relative strength over the longer term. On the rally to day X, the stock's position of relative strength was reinforced. It was able to make up more than half of the previous decline, while the market was only able to make up a small portion of its decline. This relative strength was the principal reason given for selecting this stock, and it is a valid one. This trader did not make the mistake made by the first trader. He remembered that relatively strong stocks should be bought and relatively weak stocks should be sold. Buying on relative strength, as a rule, makes sense. However, it becomes questionable if another very important consideration is overlooked. This is the matter of potential. When we buy a relatively strong stock, it is important to make sure that it has a higher objective. All the relative strength in the world means nothing if the stock has already gone as far as it's going to go, and this one had. The only up count in effect at the time had been built at the 44 level. It had a clear objective of 49. As of August 11, that objective had been reached, and no additional potential had been built. Therefore, he was buying into a stock that had nowhere to go. The best that could have been expected was horizontal action. The only way account could have been taken at this point would have been to see the rally from 44 to 50 as a move to an important last point of supply. If this had been seen, the result would have been a down count with an objective of 38 to 41, which was fulfilled in September. Obviously, if this had been seen, no long position would have been taken. At first glance, it would appear that our trader was making another major error. He seems to be buying on a rally. Buying is to be done on reactions, not on rallies. If his position had been intended as an intermediate trade, this error would have, in fact, been made. However, since we have decided that his trade was intended to be short-term in nature, perhaps we should take a closer look. The short-term uptrend has been marked on the chart. Notice how in the week prior to day X, the price had run into the overbought line of that uptrend. This indicated the need for a correction. Consequently, during the days leading up to August 11, the stock first moved sideways and then reacted back to the support line of the trend on August 10. The volume on that day was especially low, indicating that the correction had been completed and the test of the support successful. This positive correction was perhaps the single most important reason behind the trade. Therefore, on August 11, disregarding the fact that there was no upside potential, the long position was taken. The stock made some immediate upside progress, but the next day was turned back and closed at its low. There was a modest increase in volume. Even so, the uptrend was still intact. This temporary setback was probably just a further confirming of the support line. The next day, this would be Thursday, August 13, Hewlett-Packard penetrated that all-important support line. The primary reason for taking the position had been put into doubt. The next day, the breaking of the uptrend became decisive. On the next attempt to rally, he should have gotten out, or relied on his mental stop to get him out. Where was his mental stop, however? Since he had no upside potential, he could not pick a price that maintained a 3-to-1 profit-risk ratio. That being the case, he should have relied on his uptrend for help. Once that uptrend was broken, his reason for holding the position was gone. Therefore, his mental stop could have been at 47 7/8. When the stock traded through that level, he should have gotten out. He didn't. From the information supplied, we know he rode all three positions down to nothing, or nearly nothing. This should never be allowed to happen, and only the trader can prevent it. The second position was taken in Hughes Tool calls. Here again, our trader was selecting a relatively strong stock to buy, which was a correct action. In this case, he corrected a major error that had been made in the first trade. This stock did have a remaining upside potential. The count at the 37 level indicated a possible upside objective of 53. That meant that on August 11, there were still 9 points left. Although the stock can be justified as a potential long candidate, its position at the time the trade was made makes the trade highly questionable. This long position was established while the stock was rallying and, more importantly, while it was in an overbought position on its uptrend. We have already established that long positions are to be taken on reactions, not rallies. It should now be pointed out that long positions are to be taken when stocks are oversold and not when they are overbought. The overbought condition in effect on day X needed to be corrected. It would not be by a further advance. Therefore, any decision to trade this stock should have been postponed at least until a correction had been completed. The figure chart indicates that this should have occurred between 39 and 40. As it turned out, the best the stock could manage in that area was a momentary hesitation at the support line of the uptrend. By waiting to see support develop in this area, which didn't, the trader might have been able to avoid a loss. This position was probably based on relative strength and the higher objective. When these two factors failed to produce the desired result, what did our trader do about it? Apparently he did nothing. This is a shame because he had the basis for establishing an intelligent mental stop. When he bought the option, there was a 9-point potential remaining in the stock. If the trader was intent on maintaining a 3-to-1 profit-risk ratio, he should have sold out when the price dropped below 41. This is the same procedure that should have been used by the first trader. The second trader might also have used the alternate procedure for selecting his mental stop that was discussed earlier. Our trader's third position, the one taken in the options of IBM, appears to be the most acceptable. The stock was showing relative strength over a short to intermediate term. It was not overbought and had about 5 points of remaining upside potential. The one mistake that does appear to have been made was buying during a rally. To do so always increases risk. He also was buying as the price approached a supply line, which is questionable. Unless there is overwhelming evidence to believe that the supply or resistance will be broken, it is better to wait until after the resistance has been broken and then buy on a reaction that confirms the break. The fact that the supply line was so close may not have been noticed or may have been disregarded on the day the position was taken. However, its presence should have become more apparent over the next 3 days as the supply continued to restrict the upside progress. This suggests that the position was taken perhaps too early. The only way that IBM was going to reach its upside objective was by breaking through the resistance. Since signs were that this was not going to happen immediately, a conclusion that the trade was too early was in order. The decision whether to get out and wait or hold on and wait pretty much has to be left to the individual. It should be remembered, however, that when it comes to options, time is perhaps the most critical factor. It is unwise to wait too long. After hesitating around 58 for those few days, the price dropped back to the vicinity of the halfway point of the previous rally and met support. This appeared to be quite constructive and resulted in the defining of a new short-term uptrend. At this point, our trader may have breathed a sigh of relief. There was no getting around the fact that his position had been taken too early, but the construction of the new uptrend gave it new life. That life lasted for only about 4 days because that is when the uptrend was broken. As with Hughes Tool, the existence of an upside potential made it possible to establish a mental stop. Since the remaining potential was 5 points, a mental stop 1 5/8 points below 58 could have been justified. This would have maintained a 3-to-1 profit-risk ratio. Unfortunately, our trader again failed to make use of this idea of a mental stop, and he paid a big price. The individual who cannot or will not make use of this concept probably does not belong in the option market. Many newer students of the Wyckoff method, upon completion of their studies, are inclined to wonder if the longer-term application that the course seems to stress still applies. They point to what appears to be a greater volatility as a reason for believing that the application would have become shorter-term oriented, especially during the last 10 years. Do they have a point? The answer is partially. It cannot be denied that the market has become more volatile in recent years. This may be as a result of the emergence of option trading. It may be as a result of uncertain economic conditions, or it may be a result of a large number of factors. Whatever the reason, the effect is to make shorter-term applications a more realistic alternative. This should not be taken to mean that longer-term applications have become a thing of the past. They haven't. and the experience of the next investor should serve to illustrate this. His position was taken in U.S. Steel, which is pictured in Exhibit 7. To begin with, let's hear what this investor has to say about his actions. His comments represent an excellent use of the Wyckoff concept. I was attracted to U.S. Steel first by its figure chart. The decline in 1978 and 79 became gradual and orderly. This created the possibility for large counts. On the vertical chart, I have drawn the long-term creek created by the trading range in the 16 to 26 price area. Last December, where I have marked 1, you have an example of trying to go up, then down, with a close in the middle on increased volume. The stock then began a slow rise, and I bought 100 shares with a stop at 19 3/8. On the rally to 25, you jump a branch of the creek. It then reacts to the edge near the halfway point, and volume dries up. Here I bought my second 100 shares with a stop at 21 3/8. Another try to go up, then down follows. The stock jumps the main creek the next day. There is very little backup, and I didn't add to my positions. Steel became stronger than the market and moved well until the area I have circled, around 35. Here the stock is stopped by its supply trend line. The following reaction to 31.5 is not completely unexpected. The rally from the oversold condition becomes weak, and at 3, I sold out my stock. This investor made a 43% profit in about 4 months by trading a very conservative stock. What did he do right? The correctness of his actions probably began long before he took his first position. From what he said, it appears as though he had been following the stock for a long time prior to the buying of the first 100 shares. This means that he had an opportunity to gain a full understanding of the stock's character. This does not guarantee a profit, but it greatly improves the odds. A thorough knowledge of the stocks being considered as trade candidates is far more desirable than the brief glance acquired during a random walk through a set of charts. Sometimes a really great opportunity will jump at you in this way, but most of the time this will not happen. More often than not, what will jump out is an opportunity to make a major error. When the first position was taken, it was shortly after one of those critical days when the price tried to go both ways and then closed in the middle on an increase in volume. We perhaps do not stress the importance of these days enough. When they occur, the indication is that the stock is ready to move. Our investor waited a few days to see which way the stock was ready to move and then stepped in. In this case, we should not be inclined to say he was chasing the stock. His second position was taken on the back up to the edge of a creek, which we have seen in the past as one of the best buying opportunities. Notice that he raised his stop on his second position. Assuming he did the same with the first position as well, he has virtually eliminated the possibility of a loss. When steel began to move from point X, our investor did something that often produces problems for many students. He redefined his uptrend. Without that, the rally to 31 would have been seen as an overbought condition, and perhaps the beginning of an end to the move. Did he redefine the uptrend to keep from having to say that an oversold condition existed? We don't know for sure. After the rally to 31, which at the time looked to be an overbought condition, the price reacted back to Y and met support at what had been the supply line. As long as he waited for this important positive indication before redefining the uptrend through point X, his action cannot be faulted. If he did it before this, his action was somewhat premature and just happened to work out. When the stock entered the circled area, he realized that it was overbought and in need of a correction. He was probably also aware that the upside objective range had been met. He could have justified selling at that point. The fact that he didn't may have been greed, or it may have been the result of a desire to see if another area of accumulation might form, to take the price still higher, and perhaps produce a long-term capital gain. As it happened, the attempt to resume the rally after the correction was unimpressive. Our investor sold out when it appeared that the uptrend was in jeopardy. Time does not permit us to go into enough detail of another experience, so we will stop here and save the others already received and those that probably will be received for another time. The three experiences we have presented here have contained some of the most classic and most commonly made errors. Hopefully, some of our suggestions on how they can be handled will prove helpful, should you find yourself making some of them in the future. Of course, the ultimate goal should be not to make the errors at all. The best way to do this is to really know your stock. Ask yourself, do I really want to take this position? How did the stock arrive at its present position? What are the possibilities for its future? Be sure you look at all of them. Of course, never forget the general market. Often it is the difference between a profit or a loss. Above all, don't be in a hurry. If you can't find a justifiable trade today, perhaps you will find one tomorrow. The market will still be there.